So Toby is the founder of Harbour, an investment consulting firm providing support to the Australian wealth management industry. Toby spent the early part of his career in institutional funds management in London and subsequently developed an interest in applying institutional techniques to individual investors. Prior to moving to Australia, Toby held roles and portfolio management in SG Global Private Banking and HSBC Private Wealth Managers. And in Australia, Toby worked in research for Standard & Poor's and UBS Wealth Management before heading research and advisory for Citi Bank Wealth Management, and most recently as CIO for the ASX-listed Centrepoint Alliance. So Toby, thank you so much. Again, I think it's more of a macro portfolio view that you bring to the discussion, so looking forward to that.
Thanks, Kieran. Yeah, well, it's a great introduction and very helpful because it kind of introduces very neatly what Harbour is all about. It's really an expert in solution structuring for different groups and types of clients as well, ranging from family offices, charities, endowments, and of course financial planning firms as well, which are about 60% of the business currently. So why that's important is because a lot of the clients come to us saying, well, we don't actually have any constraints around asset allocation in the same way that financial planning firms often do through platforms. Some of them just say, we have an objective, we need this liquidity objective, we need this return with this kind of risk, what can we expect? And then there's the work that goes into that, structuring the portfolio, and then also helping the CFOs, guiding them on what to expect in terms of income and capital preservation over their working horizon. So it varies quite a lot in that group, but there are some common elements of philosophy that lead into structuring and doing that work with those clients. And one is that, for the work that I've done over the last 25 years or so, asset allocation definitely dominates the returns and the risk in portfolios. And I think ours is relatively low compared to a lot of clients, so you often are brought in for remediation when someone's had a bad experience with a consultant in the past. And often you'll find it's an investment committee where they might have 3 or 4 consultants around the table that are very, very happy to argue until the cows come home about manager selection. But then when you actually go and do the research on how the portfolio is positioned for the last 5 years, you find that 90% of their returns came from strategic asset allocation, and the other 10% was kind of, just a bit of noise in the background. So that's often the case, and usually when you then take it down to the holdings in the portfolio, even though you might have sort of 4% in one manager, 4% in another, what you find is quantitatively, because of the interaction with the other things in the portfolio, that you find quite concentrated bets, which is something that we try and avoid as well. So philosophically speaking, I'm trying to get the asset allocation down to a lower driver of returns by layering in different bets in smaller size. And actually, when it comes to things like alternatives, looking for genuinely diversifying strategies, looking at things like cluster analysis and sort of the next leg on from just simple covariance analysis. So that means that, from implementation costs, if you've got an edge where you're looking at asset allocation and different factors that drive markets, then you want to be implementing as cheaply as possible as well. So we use a lot of smart beta ETFs and funds, as well as passive ETFs in the process, as well as active managers where they're genuinely delivering value. So as you can probably gather, the investment process, to put that into practice, is very top-down, starting with asset allocation first, and then going through all the different layers and different sizes. So what we're trying to do is build portfolios that are capable of outperforming whether the market is going up or down, but at the same time we're trying to get a nice gap between upside capture and downside capture as well, so you get better capital preservation when things get a bit more volatile. So in order to do that, the insight that I brought from institutional funds management, if you like, was that when you're dealing with sovereign wealth clients or others and they come in and say, we need a portfolio that does this, everyone wants slightly different flavors of the same thing, and the way that you customize it is you have a central investment process and then just tweak it with exclusions or different weights or currencies as the client's need. So the firm is built around a central investment process. That's really the heart of it. So starting with economic analysis, which I think is the reason why I'm here today. Also then focusing on the impact on asset allocation long-term, from long-term capital market assumptions and then structuring, and then more short-term in terms of tweaking portfolios through the investment cycle. So what does economics mean? For me, it means really not trying to forecast GDP in the same way an external consultant might do for a business. I mean, there's plenty of other people who are much, much better than that than I am. what I'm looking at is where are we in the cycle from a business and earnings growth, real yields, liquidity, and what does that mean for asset prices, and how should we be positioning portfolios? So we're looking at asset classes, factors, styles, and sectors, and currency as well. And then obviously you're bringing all that together, there's very disciplined and technological risk management as well. So turning away from the firm and then just presenting perhaps what is our base case outlook for the global economy. I think Grant did an excellent job of going through the impacts in different regions and don't really have very much difference in terms of view. And it's actually consistent with what you're seeing from the official institutions. So the latest World Economic Outlook that came out from the IMF last week was again pointing to robust growth, relatively speaking, in China and the US. Everyone else sort of in and out of recession, Germany in a terrible place, and slowing growth over the next 5 years to the extent that we're likely to see the lowest growth in a generation. So what does that mean? Well, it means that in terms of where we are in an economic cycle, if we do see a downturn in the US and continual deceleration in growth, the get out of jail free cards that we had in the last couple of cycles with emerging markets being resurgent and coming into global trade, that's not there. We're all synchronized on the same path. So that put option, if you like, economically speaking, isn't quite there the same way that we had it in the past. And that means that when we see this highly synchronized global economy, everyone making individual monetary policy decisions, we're squashed onto the same cycle by the pandemic, by inflation, and by the monetary policy response. The chances of over-tightening and seeing quite a nasty slowdown emerge as a surprise in 2025 and 26 is actually a bigger risk than it normally would be. So again, going back to the IMF, they'll say, well, we're sort of slowly decelerating growth, but be aware of the fact that the risks are heavily skewed to the downside rather than the upside. So in building portfolios at the moment, that's the backdrop that we're kind of cognizant of. In terms of what it means in the US and the election, well, that GDP number might be quite good. In fact, last night we had third quarter GDP come out at an annualized 2.8%. But yet the experience of the everyday American has probably been quite different. Kieran put up a slide at the beginning where you're looking at disposable income. On the left-hand side there, I've got nominal retail sales in grey, and then they're deflated by CPI into real with the dark blue. And it's basically saying that, well, we had a big shot in the arm and a boost in 2020, but since then, household experience in terms of living standards has basically gone sideways. And there's a lot of frustration there when you see the stock market doing well and your purchasing power eroded. That can be something that's easily weatherable if you're seeing growing employment prospects, and unfortunately we're not. We're seeing quite the opposite at the moment. If you just look at quits and hires, it's probably a better signal at the moment than just the number of job advertisements. And hires, we're back down to 2014 levels, and if you adjust these for the population increase, it's actually even worse. But that's weighing on a lot of people's minds. And even though we had a bit of an uptick overnight, you can see that consumer confidence, which is inverted on the right-hand side, is not particularly strong. It's not really recessionary, but it's not great. And consumer confidence tends to lead unemployment because people know when their jobs are starting to get a little bit more precarious. So you're starting to see that come through, and that's suggesting that unemployment trends will continue higher, as Grant said as well. So the reason why that's important for as far as the election is concerned is because if you look at this Gallup poll here, which was conducted in a couple of weeks in September, the number one issue for Americans is the economy. We've got 38 plus 52%, so 90% of Americans basically saying it's either very important or extremely important. And obviously what you see in markets and performance is not the experience of the everyday American. And so, what the central election campaign tenets of reproductive rights or immigration or even trans sports, if you look at the Republican ticket as well, it's not really touching on the big issues there, and that's why you're really not seeing a lot of momentum behind one candidate or the other. So I think there's a danger in getting too cute in thinking about really what the economic outcomes are going to be specifically from these different scenarios. But there are things with broad strokes that we can glean. So first of all, if we start on the left-hand side, Democrat versus Republican-controlled Congress, the polls are pretty conclusive that Republicans are extremely likely to control the House and the Senate. So that's like an 80% probability. Democrats have outperformed in the midterms over the last 2 weeks, so we can't rule it out altogether, but the chances of a Democrat House and Senate looks very, very unlikely. So we're really looking at the bottom two quadrants in terms of outcome there. So on the Harris-Walz ticket, well, you know, if they're working with a Republican Congress, then the first thing that comes up is the negotiation of the debt ceiling in January, February next year. So if you recall, that was suspended until after the election by agreement between the Biden administration and the Republican Congress previously, so that comes up again. So whatever Kamala Harris said in her election promises about, you know, tax breaks for households and redistributing income is going to be tempered down to a certain extent, and you're going to bet that the Republicans are very likely to hold Ukraine over her head and the defense spending there, and they're very, very likely to push for more tax breaks or the extension of the tax breaks for households and corporates as well. So even though we've got a pretty clear idea of what's in the Harris-Walz program, it seems very unlikely that it's going to be enacted in anything that looks like that current form. In contrast, if you look at Donald Trump's program, there's a lot less detail for a start. It's more favoring wealthier households through income tax, extending the corporate tax breaks and perhaps even increasing them to 15%, so down from 21 to 15% for goods and services produced in America. There's estate taxes figuring into that as well. So you end up with a situation where the growth impulse is probably lower, and you have much, much bigger problems with the deficit as well. So yeah, that's basically how we look at the two different scenarios. One where you have a lot more volatility if Harris and Walz win, and one where you have a lot more problems with the deficit and economic growth and possibly shrinking labour pool from the Trump Vance ticket. In terms of probability, I think, you know, if you just go by the polls, you say it's sort of 50-50, and that gives you an allocated probability of maybe 10% in the top left, 10% top right, 40% in each of the bottom. And then we can all have our own opinion about which one of those is more likely. With that, I'll hand back to Karen.
That's fantastic. Toby, thank you so much. I think it was really, really fantastic. Great insight there as well. So I really appreciate it.